Hello and welcome to a brand new edition of Inside Out on the Road. Well, it's a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and also tell you about the key risk and triggers going forward. Well, let's not waste any time and get to our first stock today. My colleague Sonal visited Praj Industries plant in Pune, and she gets us a deep dive into this stock.
Well, we are at the headquarters of a company that has seen the first mover advantage in the biofuel revolution. Praj Industries, which is into industrial biotechnology, and basically companies engaged in the design, manufacture, supply and commissioning of fermentation and distillation equipments for the manufacturing of ethanol. It has three segments. The biggest one being bioenergy with 77% revenue contribution, 17% is from engineering, and high purity, which is 6%. The street has been very bullish and optimistic on the first segment because of the big ethanol push by the government. Companies into the first generation ethanol technology that is transforming first generation agri feedstock into bioethanol. This would include sugars found in sugarcane juice, molasses, starchy grains and tubers. And the second generation bioethanol, which is a more sustainable technology, 80% less water requirement and has higher ethanol yield as well. They also have renewable natural gas technology, biodiesel technology and sustainable aviation fuel technology, catering largely to domestic markets with 84% revenues coming in from here and rest from exports. As far as the financial performance is concerned, they have been able to almost double their revenues and profits in FY22 with margins of 8%, and that is a good performance in a difficult environment. Now that the ethanol blending target of 10% has been achieved before timelines and the next target by the government is 20% blending by FY26, and the company is focusing on other aspects of business as well, let's understand the business overall and the plans of the company as well. Well, as promised, we have with us Mr. Shishir Joshipura, who's the MD and CEO of Praj Industries. Mr. Joshipura, it's a pleasure to have you with us on Inside Out, and there's so much excitement about the company, what it does, what are the prospects. So thanks a lot for joining us and telling us all about it. Basically, Praj Industries provides technology to, say, distilleries in order to ensure that they produce ethanol. So that's the thing.
Absolutely correct. So we don't produce ethanol ourselves, but we allow our customers to choose a feedstock. We help them to choose a feedstock, depending on where they are. Give them a technology that enables them to take that feedstock and convert that to a usable form of energy. Ethanol is the most popular form of energy as of today.
Right, absolutely. So we have been hearing about how India has achieved the 10% blending way before their targeted date. The next one is 20% by 2026. In that scenario, let's talk about the first generation ethanol. What is the opportunity here? How much do you think India needs to reach that 20% mark by, say, FY26? So that would mean distilleries putting up more capex. If that happens, what is the opportunity with your kind of market share that you see in terms of revenue growth for you?
Yes. So if you look at it, in 2018 was what I call a watershed moment in the country when the new national biofuels policy was unveiled. At that time, it was estimated that, and that time the target was 2030.
Yes.
That if we go to 20% by 2030, we'll need to create roughly an additional capacity for 1,000 crore liters of ethanol. Now, ethanol is a seasonal product in a sense that it depends on an agrarian feedstock, and therefore you may not be able to run your plant for 12 months in a year. So there is a difference between installed capacity and what you actually get. And gradually that problem is also getting solved with multi-feedstock plants, etc., etc. So as we moved away, and then I think at some moment in time, government decided to give it a big push, and they said, no, not 2030, 2025 is when we want 20%. So that means that we have to create all this capacity in a short span of 5 to 7 years, right? And that is the wind in the sail, if I can use that word right now, where the whole country is now racing to create that capacity, because we don't have the capacity, we have to create that capacity. There have been a whole host of interventions around freeing up the feedstocks. It's no longer only sugary feedstock. Government has put up starchy feedstock. You might have heard, and we can talk a little later about that as well, the lignocellulose feedstock, where you take the agricultural waste and then convert that to usable form of energy. So suddenly the canvas is enlarged. There's a big wind in the sail, and therefore suddenly everybody is rushing to create the capacities. So
are you catching the sail then?
And yes. Well, we are very happy. As you were mentioning earlier, our founders saw this vision 38 years ago when
Yes.
nobody talked about this. And I think it's a great credit to that vision and the commitment over a period of time. Now everybody is putting these capacities,
Yes.
but for all these years, there are very few and far in between plants that were coming up. So it took a lot of resilience to sort of stay true to the cause and vision and commitment and passion. So all of that is what built Praj today. And what that meant was, so when actually the tide turned, we are fully prepared.
You are.
and that has enabled us to, so we are currently a very, very large market share player. We have dominant, I would not use the word dominant, but a significant share of about 2/3 of the market in our
Right,
favor.
that's dominant. So, exactly, numbers on that. Say 1,350 crore liters of ethanol is needed in next 5 years. That would mean distilleries putting up capex of say 10,000 to 12,000 crore rupees, if I'm not mistaken. So with 65% market share, you'll be able to do 8 to 9,000 crore rupees
That's what we should be looking. That's the kind of
in 5
canvas
years
that will
down.
unfold. Yes.
So from 2,300 crores in FY22, you plan to reach that level by FY26, so to say.
Yes, so these capacities will get built over a period of time. So every year they'll sort of get
Yes.
divided into the years. But our turnover that you see of 2,300 crores is also consisting of other businesses.
Yes.
But yes, 66% of the unfolding opportunity is what we want to
Okay.
target.
That's interesting. So that's only about the first generation ethanol, right? The next one is 2G ethanol. And recently IOCL put up a plant. What was Praj's contribution to that? And if you can just explain, how is 1G different from 2G? Is it easier to put up a 2G plant capacity or technology, so to say?
Yes, as I was mentioning to you, the first generation ethanol is typically referred to ethanol that gets produced out of feedstocks that either have a sugar already present from some kind of processing of an agriculture feedstock, say sugarcane. So you take a sugarcane and you start from there, and you can start from taking the juice out from the sugarcane, and then onwards you can go all the way to extract entire sugar from it and then what's left, or you can take an intermediate stage saying part sugar, part waste and so on, or only juice itself. There's starchy feedstock, which is around rice and maize and these kind of wheat grains actually. So India as a country has another problem to solve, and that is that we have large stocks of grain that are not fit for human consumption.
Right.
A. B, we continue to produce more than we need. Even after we account for all kind of safety stocks, that there's a 3-year drought, that there's a 15% sudden increase, all those factors if you take in, even then we have additional surplus feedstock available.
Okay.
Take sugarcane, process it, what's left, convert it, 1G.
Okay.
Take starchy feedstock, rice, broken rice, not fit for human consumption rice, maize, whatever, we can ferment that and convert that to ethanol. There's a third category, and that is in popular plants what's called as parali, or rice straws standing in the field. So today when a farmer harvests his crop, the straw is left standing in the field. What do they do with it? If there is no market for it, the best way to dispose of is to burn it, torch it. Now the technology provides that you can take the straw, give it to me, I'll pay you for it. So now there's a monetary benefit to the farmer. Don't burn it, give it to me, we'll convert it to ethanol. That's what the Indian oil planting is all about. So that's the second generation ethanol, where you take a residue. Yeah? Now the residue can come from agriculture fields, but it can also come from forests. You've heard about the famous forest fires in California,
Yes.
right? So we can also take those wastes and convert even that to ethanol. So you're not only taking away a source of destruction, but you are actually making a constructive activity.
So it's profitable, Mr. Joshipura. Is it a profitable proposition to invest into 2G ethanol? That is because that's a very less companies, even globally, are into 2G technology. And do you expect it to grow at a similar pace that we saw for 1G ethanol?
Yes, in the sense that, of course, when in any activity has to go commercial, you must have proof on ground. And these Indian Oil project is proof on ground.
Okay.
Okay, so people say, yes, it works. Now we know that it works. Because the outlays are large, so risks are large. People would like to see, and I think the technology is at a different curve of development compared to say 1G, which has been there for 30 odd years.
Right.
But that's the way world will go, because in terms of GHG reduction, typically a 1G plant, you'll reduce maybe 30-40% compared to conventional fuels. But you go to 2G, it could be 80-90%.
Okay.
And in some case, you can even go negative. Okay. So it depends on where the other logistics of the supply chain are. So fundamentally, if you think about it from a broader perspective, one fine day we will meet the potential of sugarcane. Another fine day we'll meet the sugar potential of all the starchy feedstocks. And then there'll be these waste. This is essentially waste, which even the animals don't eat.
So that can
we are
be
able
useful.
to convert it to, and it has no value today, which becomes very handy.
So let me play the devil's advocate here, because I just want to understand how sustainable this growth around ethanol is. Because one thing I want to understand is, once you provide this technology to the distilleries, does it stay for them for a longer period of time, or do you get repeat orders here? How long can they use that particular machinery or equipment for? And the second thing is, say once we reach that 1,350 crore liters of and 20% blending, of course, government will keep raising those targets, but once it reaches, what will lead to growth here? What will it plateau? Will it grow at compounded rates? So what is your take?
Yes, so great question. So let's take a scenario to understand. So let's say EBP 20 and nothing more.
Right. What next?
Just if there's nothing more, then we will stay put at 1350 crores, and then there'll be only a marginal increase as the consumption of the petrol increases.
Right.
To that extent it will increase. But that's not, thankfully that's not the scenario. So as you said, the first thing is that we are blending 20% today. That's the plan for 2025, right? We already have a case in the world, in Brazil, which are at 27% blending. So we already know that 27 is possible. But Brazil has gone much ahead. They have actually stated that by 2030 they don't want to import any energy. And they are driving a very different program. So they have said, you've probably heard about the flex fuel vehicles that even honorable ministers have talked about. So now in Brazil, if you go, you can go to a pump, you can say, you know what, I want E100. That means I want everything ethanol. I don't want any. So that's what the flex fuel vehicle is about. They give you a flexibility to operate between conventional fuel all the way to zero conventional fuel and go to ethanol. And you can choose what you want, right, as a driver. There are some economic questions around it which needs to get addressed individually as well. But as you rightly said, you didn't even ask me what's the cost, right? You just said I'll do something that's good for my children. So I think and that's what is going to drive. So that's one dimension. So there's a journey beyond E20, E27, up all the way to E100.
Okay.
Which will need some ecosystem development around flex fuel vehicles, etc. There's another dimension, and that's about, we are blending today in petrol. What about blending in diesel?
Diesel, right.
Which is actually in India's economy 3 to 4 times higher volume compared to petrol. So we are working on a program on that now to see how that could be achieved. We have already passed tests up to BS4 levels. Now we want to go to BS6. And diesel is a very interesting subject because there is diesel in Indian Railways, there is diesel in stationary engines, the DG sets as we call them, or generators, and then there is diesel on moving vehicles. Right? And these are very large categories. Just to give an example, there are also very small DG set which get attached to every telecom tower.
Okay.
Because telecom towers have to have uninterrupted power, right?
Right.
And we were just doing an analysis to see if all of those are just made into ethanol-driven engines and not diesel.
That's a big
opportunity. It just opens up a large market for us. So one pathway is E20 changing its number, 20 to 27 to 100, diesel blending coming into the play. The third, as I was already mentioning to you, iterating the ethanol and using ethanol as a feedstock then for aviation fuel.
So those are the three big opportunities.
And that becomes a very big, that's much bigger than what 1350 crore liter is, much bigger.
So of course, so on the second one, the companies keep asking for, they order again, how long is this technology valid for? And with that 3,300 crore order book that you have right now, if you can give us some visibility, say 5 years down the line, with this big rush for ethanol that is coming in, what is that looking like?
So the way we look at it is like this. So when we give a license to our customers to set up a plant, it is for that plant for life.
For life, okay.
So that plant is for that. They want to put up another plant, then they have to buy it again.
Understood.
And so on. That's how it works. It's not transferable. So we expect them to, it is for that particular plant itself that the technology is given. As the plant starts to run, that's something that we have also recognized. There's a lot of interventions that we can do because we understand how the ethanol gets produced more and more efficiently. So there are also a set of solutions that we are now introducing in the market, which will enable to operate it more efficiently, not only build it efficiently, but also operate it. So that's another stream of revenue that starts for us. the aviation will become another revenue line for us.
This is the long-term growth plans that I'm asking you before I let you go on this one. High purity and engineering, smaller segments for you, but what is the growth expected from there? And considering all that you told me, what is the revenue potential? Say 8 to 9,000 crores is what you said for 1G ethanol, and you said it's only from 1G ethanol. So say by FY26, what kind of revenues are you targeting? What is the margin picture with more products coming in? Will it be margin dilutive? Will you maintain this 8 to 9% trajectory that you have been doing so far?
Okay, so the good news is that what's happening on this, we were talking earlier about this phenomenon of energy transition, which means that the world is moving from high carbon fuels to now low carbon fuels, but eventually to no carbon fuels, which is the green hydrogen thing that we keep hearing about and other derivatives. Right? Now, if that happens, already a movement has started. There are a lot of capacities being announced on green hydrogen. Our engineering business, one of our engineering business arms, actually serves that segment very, very well. They are partnering with absolutely the leaders in the field globally to actually become their partners for engineering and manufacturing. So there, the process technology is not ours, but the engineering and the manufacturing is ours. There also we are saying on the side of it, once that plant is done, there are streams that come out, and can we provide value-added solutions to those streams? So we see a big canvas unfolding even on the engineering field as well. So I was telling about the big wind in our sails on the 1G domestic, but even as that is happening, we are not changing the ratio between our bioenergy to engineering businesses, and that is indicative of the fact, and that business is almost entirely export oriented.
Right.
So we believe that as we move forward, we will see a higher, and that's where the 40% number comes from. We will see a higher portion of international business in our overall portfolio, which is value accretive, because it obviously comes at better margins.
And by better margins, you have to give us that number as well, sir. I will not let you go without a number.
Okay, so my CFO will kill me if I give that number. He'll say you're not right. But what's important to know is that a healthy mix, and we have this theme inside that we are talking to our teams, and we say, do we want to become big, or do we want to become big and healthy? And the choice is obviously the second one, which is the tougher one. So we are saying very clearly that we want to stay big, we want to stay healthy, and everybody expects a double-digit margin play on the bottom line, and that's our aim. That's where we should move.
So double-digit margins is your aim, and growth maybe say 20 to 30%. That will be big and healthy for you.
I think my chairman has already said that we expect to grow at 30 to 40% through at least the foreseeable future as we walk down this path.
Okay, so that is interesting. A lot of exciting stuff that is happening in this segment. So good luck to you, Mr. Joshipura, for all the future endeavors, and thank you so much for speaking with us today.
Thank you, Sonal. Thank you for having me. It's a pleasure.
Well, that was a deep dive into Praj Industries, but it's time to slip into a short break. We'll come back with another interesting stock. Navneet Education is the stock on our Spotlight segment. You stay with us.